Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Good morning.
We've got quite a stack today. Sources from Bloomberg, The Wall Street Journal, Barron's, really painting a picture of, well, a dynamic financial landscape, to say the least.
Yeah, it's certainly dynamic, lots of moving parts.
Exactly. So today we're doing a deep dive. We're looking at AI's impact, on software stocks, the Fed's Balancing Act, always interesting, and even some pretty surprising shifts in sustainable investing. It's moving fast out there. Our mission, like always, is to pull out those key nuggets for you, help you cut through all the noise.
Absolutely. Today's headlines really show the cross-currents, don't they, shaping global markets right now. We'll try and connect some dots, maybe some that seem a bit separate at first glance.
Right.
Look at the underlying forces and, why this stuff actually matters for the bigger economic picture. It's fascinating how fast the story can change and how linked everything really is.
Okay, let's unpack that first big one then. This comes straight from Bloomberg. AI disruption fear sparks investor scrutiny of software stocks. For years, software companies were the darlings, weren't they? Mark Andreessen's famous line from, 2011, software is eating the world.
Still echoes today.
It does. But here we are 14 years later, and AI is getting that same kind of massive hype, and now investors are asking, wait a minute, is AI about to eat them, the software guys?
It's a huge shift in perception.
Yeah.
Bloomberg really lays it out. You look at Salesforce, Adobe, ServiceNow. These were leaders.
Absolutely. Household names in the tech world.
And now, some of the worst performers in the S&P 500 this year, down collectively, at least 16%? That's about $160 billion in combined market value gone.
Wow, $160 billion. That's staggering.
It is. And look at the Morgan Stanley SaaS basket software as a service stocks, down over 6% this year.
Yeah.
Meanwhile, the NASDAQ 100, the tech index, is up 12%.
So a real split happening within tech itself?
A definite divergence. And it's not just the giants feeling the pinch. Companies like Asana, HubSpot, Bill Holdings, Vertex, major laggards, down 29% or more. Monday.com even saw a 30% share price drop after a weak revenue forecast.
That's a serious tumble for companies that, seemed almost unshakable just a little while ago. So if some are struggling this much, what separates the winners from the losers in this AI wave? Is it just about bolting on AI features or something deeper?
That's the core question, isn't it? It seems to be about how you use AI. Are you playing defense, just trying to keep up? Or are you playing offense?
Offense,
Meaning using AI fundamentally, like Microsoft, Oracle, Palantir. They're seen as leveraging AI to potentially drive serious growth. Palantir, for example, thinks its AI products could fuel 45% sales growth this year.
45%, that's huge.
It is. And the threat for the more traditional software firms is, it's real. If AI can do similar things, productivity tools, digital tasks, but cheaper, what happens to their premium pricing model, their whole value proposition?
It's on subscriptions, yeah.
Exactly. Robert Ruggiero from Brave Eagle Wealth Management put it well. He noted, tech obsolescence can come out of nowhere.
A scary thought for investors in that space.
And you see it in the valuations. That Morgan Stanley software basket trading at 23 times projected earnings. That's half its average over the last decade, lowest since 2014. The market is definitely showing caution.
Okay, so this unease about AI disrupting software, how does that tie into the broader tech rally we've seen? Because tech overall has been strong.
Well, it connects directly to NVIDIA. Their earnings report is this week, and it's a huge focus. The Wall Street Journal highlighted this, and Tech Rally shows signs of losing steam. And Barron's, too, with NVIDIA stock waivers. China AI chips are in focus ahead of earnings.
Right, NVIDIA, the AI chip king.
Exactly. Biggest weight in the S&P 500, almost 8%. So it's seen as a bellwether, a signal for AI optimism across the whole market.
But there are concerns.
Yeah, specifically about China sales. The Wall Street Journal reported the Chinese government apparently told domestic companies not to buy NVIDIA's H20 processor, the one designed to comply with U.S. export rules.
So geopolitical tensions creeping in again.
Always a factor. And this uncertainty is having an effect. The WSJ mentioned an individual investor, Joshua Boyer, trimming his big tech holdings by about 25% because valuations look stretched. And JP Morgan data showed individual investors were actually net sellers of tech recently for the first time in 2 months.
That is a shift, especially since retail investors have been such big buyers in tech. Is this maybe a wider skepticism setting in about how quickly AI will translate into actual profits?
I think that's part of it. Jessica Leome at Decibel, a VC firm, called it a vibe shift.
A vibe shift.
Yeah. Following, the kind of lukewarm launch of OpenAI's GPT-5,
Hmm.
Meta freezing its AI hiring, it suggests maybe some skepticism is growing. Is the hype getting ahead of the real-world application and, crucially, the revenue?
Right. Can the Magnificent Seven keep up that incredible run?
That's the billion-dollar question, or trillion-dollar perhaps. It makes NVIDIA's earnings this week absolutely critical. It'll be a key test of investor sentiment, not just for AI, but for the whole tech market's direction.
Okay, quite a complex picture in tech. Let's pivot now from AI to the macro scene. Jerome Powell at Jackson Hole last Friday, he definitely made some
He
waves.
certainly did.
Signaled rate cuts could resume maybe as soon as next month, sent the bond market rallying. The Dow hit a record high for the first time this year. Quite the reaction.
A strong initial reaction, yes.
But Bloomberg's reporting this morning in bond market's big Powell rally needs supportive data to march on, and their live market update suggests that optimism is already being tested a bit. U.S. equity futures were down earlier.
Well, it's a reflection of just how tricky the Fed's position is right now. That other Bloomberg piece, Fed's Jackson Hole exposes hard road ahead for central bankers, really digs into this. Powell himself called it a challenging situation.
Challenging
Because you've got these conflicting signals. Inflation is still above their 2% target, right?
Yeah.
But the labor market is starting to show some weakness.
so push and pull. Tighten for inflation, ease for jobs.
Exactly. These cross currents, as they call them, pull policy in opposite directions. It makes deciding what to do incredibly difficult. And the market knows it. Futures traders are only pricing in about an 80% chance of a quarter-point cut in September. It's not seen as a sure thing.
Why the doubt if Powell hinted at cuts?
Lingering worries. What if inflation picks up again from these already high levels, especially with potential impacts from President Trump's tariffs working through the system?
Ah, the tariff wild card.
Indeed. And Gregory Peters from PGM Fixed Income basically said, look, expect mixed data ahead. That's going to keep the bond market on edge. It won't be a smooth ride down for rates.
So, for you listening, what does this mean for different market corners? We're seeing things like the yield curve steepening. The gap between 5-year and 30-year bond yield hit its highest since 2021. What's that telling us?
That's a really interesting signal. The steepening suggests investors are relatively okay with holding shorter-term bonds because they expect the Fed to cut rates soon.
Right, makes sense.
But they're much more hesitant about longer-term treasuries. They want more compensation for holding those for 30 years, likely because they're worried about future inflation or maybe the sheer amount of government debt coming down the pipe.
The deficit issue.
Yes, and it raises that fundamental question. Is the Fed maybe prioritizing jobs, trying to avoid a recession, even if it means risking inflation staying higher for longer?
And then there's the political angle, too, isn't there?
Absolutely. President Trump's public criticism of Powell, threatening Governor Lisa Cook. It raises concerns about Fed independence. Will they feel pressured to cut rates too much, potentially fueling more inflation down the line?
A valid concern.
Megan Swiber at Bank of America pointed out that risk. If the Fed cuts while inflation is still way off target, does the 2% target lose credibility? Does it become, unanchored?
Lots for the Fed to juggle. And quickly, on a related note, Bloomberg also mentioned oil prices ticked up this morning.
Yes, oil edges higher after Fed signals possible interest rate cut. The idea being that rate cuts could boost the U.S. economy, which means more demand for oil, though there's still some underlying anxiety about the long-term demand picture for oil.
Okay, so Fed watching remains key. Now let's shift gears to something, well, pretty unexpected. ESG investing. Environmental, social, governance.
Right, usually associated with clean energy, ethical practices.
Exactly. But a Bloomberg headline really caught my eye, how weapons of mass destruction became popular with ESG investors. I mean, what?
It sounds shocking, doesn't it? But it highlights a really stark redefinition of ESG, particularly in Europe, and it's driven by geopolitics.
How so?
Since Russia's invasion of Ukraine, there's been a dramatic shift. The number of ESG equity funds in Europe that have exposure to the nuclear arms industry, it's jumped over 50% to more than 2,000 funds.
2,000 ESG funds investing in nuclear weapons.
Roughly half of Europe's ESG-registered equity funds now allocate some capital to companies involved in nuclear arms. It's a huge change.
So the definition of good investing is changing.
It seems so, at least in this context. The rationale, as Euronext CEO Stefan Bujna put it, is shifting from simply doing no harm towards contributing to society by strengthening Europe's energy autonomy and defense.
Defense as a social good, essentially.
In this new geopolitical reality, yes.
Yeah.
And Paul Clements Hunt, who actually helped coin the term ESG back in the day, clarifies. He says ESG isn't just about ethics. It's fundamentally about materiality and fiduciary duty. And from that perspective, he argues, it can accommodate defense assets, even nuclear weapons.
Wow. That's quite a pivot. And here's the kicker for investors, right? An S&P index that tracks aerospace and defense, which includes companies involved with nuclear weapons, that index is up about 40% this year.
40%.
That's almost double the gain you'd see in typical clean energy stocks over the same time. So this redefinition, this ethical shift, seems to be aligning pretty well with strong financial returns.
It certainly does in this case. Makes you wonder, doesn't it? If you're a fund manager who was pitching do no harm ESG just a few years ago,
Yeah. How do you explain this?
how do you now explain that nuclear weapons fit into that sustainable portfolio? It's a fundamental rethink.
Definitely one to watch. Okay, let's pivot again, this time to crypto. And a name you might not immediately associate with it. The Wall Street Journal has an article, How Eric Trump Became One of Crypto's Greatest Evangelists.
Yes, quite a transformation detailed there. Eric Trump, who describes himself as more of a bricks and mortar guy,
Right, property development and so on.
is now really spearheading the Trump family's move into the crypto space.
Yeah.
A pretty rapid entry.
What was the trigger for that?
According to the article, he says it stemmed from the aftermath of January 6, 2021. Banks started shutting down hundreds of Trump Organization accounts.
The debanking issue.
Exactly. He said it made him realize how fragile the financial system was and how easily it could be weaponized.
Mm.
That experience apparently fueled their big push into things like Bitcoin mining, holding various crypto tokens.
And they have a firm now.
Yes, their flagship firm, World Liberty Financial, recently valued, according to the WSJ, at $4.5 billion.
$4.5 billion. Okay.
And now President Trump is making debanking a policy focus. He issued an executive order just this month to investigate banks potentially discriminating based on political or religious views.
Which inevitably brings up the conflict of interest question, doesn't it? Given the president's policy stance and the family's significant business interests in an area potentially affected by that policy.
It absolutely does. Ethics lawyers like Norm Eisen, who you might remember from the Obama administration, are quoted in the article. He called it an unprecedented blurring of the lines between the family business and presidential power. The White House press secretary, for their part, denies any conflicts exist. But it certainly highlights that complex and sometimes controversial intersection of finance, emerging technology, and politics.
A very modern dilemma. Okay, let's quickly round things out with a look at some other global currents making headlines this Monday.
Sounds good.
First up, from Bloomberg. Adani Wind looks abroad after 300 milliW India turbine order win. Adani Wind in India, they've locked down big orders domestically, 304 megawatts.
Significant capacity.
And now they're looking outward, planning to export wind turbines, clean energy machines to places like Australia, Brazil, the Philippines. They're aiming for 1.25 gigawatts in export orders by early 2026.
Shows growing ambition from emerging market players in the global renewables race.
Definitely. Also from Bloomberg, in an interesting diplomatic move, Pakistan and Bangladesh are apparently boosting ties. Pakistan's chief diplomat visited Dhaka, the first such visit in 13 years. They're talking about increasing trade, investment, connectivity.
Potentially significant regional development there.
And in Turkey, another Bloomberg report, Turkey set to end ban on investors short-selling stocks. They're planning to lift that ban by the end of this month.
Oh, that's interesting. Aimed at attracting foreign investors back.
Seems like it. Their stock market, the Istanbul 100 index, has already been hitting record highs, so maybe they feel confident enough to remove that restriction now. Could signal more market opening.
Could do. A sign of returning confidence, perhaps.
And one last quick note, also via Bloomberg. Philippines suspends GovTwork schools in capital on Tuesday. Just a heads up for anyone with interest, they're suspending government work and classes in Manila region tomorrow due to bad weather.
Okay. Good practical note there.
So as we pull back from this Monday morning deep dive,
Hmm.
it's just striking, isn't it? From AI completely shaking up established industries
Yeah.
to geopolitics, literally redefining what counts as ethical or sustainable investing.
It's a fundamental shift.
And even seeing how personal experiences with the financial system can drive a powerful family into new tech frontiers, blurring lines with national policy along the way. The financial world just feels like it's in constant rapid flux.
It really does. Constant change seems to be the only constant.
So looking across all these headlines today, the ESG redefinition, the tech disruption, the political intersections, it really makes you wonder, doesn't it? Are we seeing a fundamental reevaluation of what value even means? And how long can the old definitions possibly hold in this environment? Something to think about.
A very pertinent question for the times.
Well, that's our deep dive for today. We'll see you all tomorrow morning with new headlines from major financial magazines.